More than a decade, the number of U.S. home sellers now dramatically exceeds the number of buyers. That's according to a new report from Redfin. The shift in buying power could cause prices to fall.
West Palm Beach was marketed as America's next luxury paradise until the housing wave turned into a nightmare. In less than a year, the median home lost $60,000 in value, and CoreLogic now ranks this city among the nation's 5 most at-risk markets, with over a 70% chance of even deeper price declines ahead. How did Florida's playground become an epicenter of pain? And what comes next for residents and investors? The answers start with a warning few saw coming. CoreLogic's risk model does not hand out its highest warnings lightly. Yet in 2025, West Palm Beach stands in the top 5 nationwide for projected home price declines, flagged with a probability exceeding 70%. This classification, very high risk, is not a routine label. It signals a rare convergence of negative market forces, each measured and weighted by CoreLogic's proprietary algorithms. The model draws on a blend of local and national data, tracking everything from month-over-month price drops and soaring inventory to the lengthening time it takes for homes to sell. In West Palm Beach, inventory has quadrupled from pandemic lows, and active listings now sit at decade highs. Months of supply have jumped to 5.5, well above what the market can absorb. These numbers alone would be cause for concern, but CoreLogic's system also factors in the collapse in pending sales, the sharp slowdown in closings, and the growing gap between what sellers want and what buyers are willing to pay. Affordability metrics play a central role in the model's calculations. Even after recent price cuts, many neighborhoods remain 20 to 34% overvalued by historical standards. The price-to-income ratio has drifted far from the norms that once anchored the market, and the cost of ownership, driven by spiking insurance premiums and higher mortgage rates, has reached levels that sideline even well-heeled buyers. Migration patterns, once a tailwind, have flattened. The pandemic-era influx from out-of-state has slowed, and new demand is no longer strong enough to soak up the glut of listings. CoreLogic's risk engine weighs all these factors against historical patterns. The last time this region saw a similar warning was in the run-up to the Great Recession, when price declines and overbuilding combined to trigger a long and painful correction. The current very high risk rating places West Palm Beach in the same danger tier as the hardest hit markets of the past 2 decades. For residents, investors, and policymakers, the signal is clear. The data does not suggest a brief pause or a minor correction. It points to a market facing sustained, quantifiable pressure, one where the probability of deeper losses is now a matter of statistical record. In early 2024, the median home price in West Palm Beach reached an all-time high of $480,000. By April 2025, that number had fallen to $420,000, a $60,000 loss in less than 12 months. For homeowners, the numbers are not abstract. Families who bought at the peak now face a reality where their investment has been gutted in a single year. County records show the steepest annual drop since the aftermath of the Great Recession. But this time, the pain is spread across every price point, not just the lowest tiers. The scale of the decline is visible in the day-to-day choices of ordinary people. A couple who closed on a 3-bedroom house last spring, expecting steady appreciation, now owes more on their mortgage than their property would fetch on the open market. Agents report that sellers who listed homes at last year's prices have been forced to cut, and cut again, as buyers vanish and offers fall far short of expectations. The $60,000 drop is not just a line on a chart. It's months of lost income, erased equity, and postponed plans for a move, a renovation, or a child's education fund. This drop has rippled through every segment of the market. Single-family homes, once seen as a safe bet, have lost nearly 5% of their value in a year, falling from $644,500 to $613,250. Condos, which drew waves of investors and remote workers during the boom, have seen a 6.1% decline, with median prices slipping from $320,000 to $300,500. Sellers who hoped for bidding wars now face silence, and listings that once moved in days now linger for months. The loss is compounded by the psychological toll. Homeowners who stretched to buy in 2024 now watch as similar properties in their neighborhood list for tens of thousands less. For many, the $60,000 drop means a vanished down payment, or a hard choice about whether to sell at a loss, rent out at below cost, or hold on and hope for a rebound that may be years away. The numbers are stark, but the impact is personal. Felt in every open house with no visitors, every price reduction email, and every conversation with a lender about refinancing options that no longer make sense. As the market absorbs these losses, the gap between what sellers need and what buyers will pay has never been wider. The correction is no longer theoretical. For thousands of West Palm Beach homeowners, it's already arrived, measured in dollars lost and options narrowed. Pending home sales in West Palm Beach have tumbled, with April's tally showing a 14% drop year over year. The number of monthly closings has fallen even harder. Just 145 homes changed hands, an 18% decline compared to the same period last year. These are not just ordinary fluctuations. In the context of the 50 largest U.S. metros, West Palm Beach now ranks among the steepest drops in transactional activity. The market, once fueled by a steady churn of buyers and sellers, is seizing up. MLS data reveals a sharp contraction in deal-making. Agents report that listings which once drew multiple offers now sit idle, often with no showings for weeks. The pipeline of new contracts has dried up, and the backlog of unsold homes continues to swell. The machinery of the market, offers, negotiations, closings, has slowed to a crawl, leaving both buyers and sellers in a holding pattern. For sellers, the reality is immediate. Properties that would have sold in days during the pandemic boom now linger on the market for months. Some owners, facing a lack of interest, withdraw their listings entirely rather than accept a lowball offer. Others cut prices repeatedly, hoping to spark even a single bid. The result is a market where transaction volume is no longer supporting prices, and each failed sale adds to the sense of gridlock. On the buyer side, hesitation dominates. Higher mortgage rates, ballooning insurance costs, and persistent overvaluation have sidelined all but the most motivated or cash-rich buyers. First-time and financed buyers have nearly vanished from the closing table. Investors, too, are pulling back, wary of catching a falling knife in a market with few clear signals of a bottom. The collapse in sales activity is not just a symptom, it is a driving force behind the broader correction. With fewer deals being made, price discovery stalls, and uncertainty grows. The West Palm Beach housing market, once defined by its velocity and competition, now resembles a stalled engine, with every indicator pointing to deeper dysfunction ahead. 83 days. That's how long the average West Palm Beach home sits on the market in April 2025, more than double the national average of 40 days. Some properties linger for over 100 days, their price cut histories stacking up in public view. The days on market metric, once a footnote, now dominates every conversation between sellers and agents. For many, the waiting game ends not with a bidding war, but with a painful price reduction just to attract a single offer. Nearly 5% of homes in West Palm Beach are now selling below their asking price. Nationally, that figure is less than 1%. The contrast is stark. Where buyers once competed, they now dictate terms. Sellers find themselves chasing a moving target, forced to adjust expectations with each passing week. The listing history of a typical home tells the story. Initially priced to match last year's peak, then slashed by $10, $20, sometimes $50,000 after weeks of no interest. In some neighborhoods, price cuts have become the rule, not the exception. The shift in leverage is unmistakable. Buyers, aware of the mounting inventory and desperate sellers, negotiate aggressively. Inspection contingencies, repair credits, and seller-paid closing costs are back on the table. The days of waived appraisals and over-ask offers are gone. For sellers, every extra week on the market means more carrying costs, mortgage payments, insurance premiums, and association fees that eat into equity. In many cases, owners who can't afford to wait simply pull their listings, hoping for better conditions that may never arrive. Behind the numbers, the human toll is mounting. Agents recount stories of listings that draw no showings for a month, of open houses with no visitors, of clients who lower their price 3 times and still receive no offers. The market's price discovery process has broken down. Sellers cling to memories of pandemic-era highs, while buyers refuse to pay for yesterday's values. The result is a standoff, homes sitting unsold, price cuts accelerating, and the gap between buyer and seller expectations growing wider by the week. In West Palm Beach, liquidity has evaporated, and the path to a sale is longer and more uncertain than at any point in the last decade. In zip code 33417, the scale of the downturn is impossible to ignore. Over the past year, home values here have dropped by 8.5%, more than double the countywide average. Nearly 1 in 3 listings has been forced to cut its price, with 28% of sellers slashing their asking numbers just to draw a single offer. Yet even after these aggressive reductions, the area remains stubbornly overvalued, with properties still priced 34.1% above what long-term trends would suggest is sustainable. For homeowners, the consequences are immediate and deeply personal. Someone who bought in 2024 is now watching their equity vanish at a rate of thousands of dollars each month. Agents describe a market defined by desperation. Listings that once sold in days now languish for months. Price histories fill up with repeated cuts, and open houses go by without a single visitor. The constant churn of reductions has become a grim routine. One seller, after dropping the price 3 times in 4 months, finally pulled their property off the market, unable to find a buyer, even at a steep discount. The numbers in 33417 paint a picture of a neighborhood caught in a downward spiral. With each failed sale and every new price cut, confidence erodes further. Sellers who hesitate risk falling even further behind as the market continues to reset. For many, the question is no longer how much they'll make on their home, but how much more they stand to lose if the slide continues. Downtown West Palm Beach, anchored by zip code 33401, was once the epicenter of the city's luxury renaissance. High-rise towers along Flagler Drive promised panoramic views, first-class amenities, and a cosmopolitan lifestyle at prices that undercut Miami and Boca Raton. In 2025, that promise is unraveling. Median condo values in 33401 have dropped 4.4% year over year, a steeper fall than most coastal urban markets nationwide. For owners in these luxury towers, the pain is not just financial, it's existential. Many bought during the pandemic boom, betting on endless demand from remote workers and out-of-state investors. Now those buyers are gone, and the towers are dotted with unsold units and lingering listings. The supply of high-end condos has ballooned. Months of inventory in the downtown core regularly exceeds 9, double what most analysts consider healthy. New developments like South Flagler House and Olara once celebrated for brisk pre-sales, now face a tougher reality. Buyers are hesitant, and even well-capitalized projects must offer incentives just to keep contracts from falling through. In older towers, owners who need to sell are forced to compete with brand new inventory, often slashing prices or absorbing months of carrying costs as their units sit idle. The overhang of unsold luxury condos is putting pressure on association finances, with some buildings quietly raising fees to cover rising insurance and maintenance costs. For residents, this means higher monthly bills even as property values drop. The result is a fragile equilibrium, a market where prestige addresses no longer guarantee returns, and where the gap between expectation and reality grows with every listing that fails to close. On the western edge of West Palm Beach, neighborhoods like 33412 and 33413 present a different kind of warning. Home prices here have barely budged, down just 0.5% to 0.6% over the past year. At first glance, these areas seem insulated from the turmoil gripping downtown and older neighborhoods. Listings are not piling up with drastic price cuts, and the pace of sales, while slower, hasn't collapsed as dramatically as elsewhere. But beneath the surface, the numbers tell a more troubling story. According to the latest appraisal risk indices, properties in 33412 remain 29% overvalued, while 33413 sits at 21.9% above long-term trends. These figures mean that even after the broader correction, homes here are still priced far beyond what local incomes and historical patterns can justify. The overvaluation index, used by banks and analysts to gauge future risk, suggests these outskirts have not yet absorbed the full impact of the downturn. For homeowners in these zip codes, the risk is latent rather than immediate. So far, minimal declines have spared them the kind of equity loss seen in 33417 or downtown. But with so much air still in the price, Venezuela, and with inventory continuing to build, the threat of sharper corrections looms. Appraisers and lenders are already flagging deals in these areas for closer scrutiny, aware that inflated valuations can unravel quickly once supply overtakes demand. The market's search for a new baseline is not finished, and the outskirts may be next in line to feel the pressure. A surge of new listings has flooded the West Palm Beach market, pushing inventory to levels not seen in over a decade. By April 2025, active single-family listings reached 5,986, a 16% increase from the previous year. The month's supply metric, a key indicator of market balance, now stands at 5.5, up 22% in just 12 months. This figure means that at current sales rates, it would take 5.5 months to sell through all the available homes, well above the threshold for a balanced market. And a stark warning sign for sellers. The imbalance is even more pronounced in the condo segment. Supply now exceeds 9 months, far surpassing what buyers can absorb. Developers and homeowners associations face mounting pressure as unsold units pile up and carrying costs climb. In new towers, incentives and concessions have become standard, but even aggressive promotions struggle to keep pace with the relentless flow of new inventory. For existing buildings, the glut translates to higher fees and special assessments, as associations scramble to cover rising insurance and maintenance costs with fewer paying residents. This oversupply is not the result of a sudden construction boom, but rather the hangover from years of aggressive permitting and speculative development during the pandemic surge. Projects that broke ground in 2021 and 2022 are now delivering units into a market with too few buyers and too much choice. The result is a structural drag that weighs on prices and erodes confidence. Each new listing competes not only with other resales, but also with brand new, amenity-rich condos offering deep discounts and creative financing. For sellers, the consequences are immediate. Homes that might have attracted multiple offers 2 years ago now sit idle, their price histories reflecting repeated cuts. Agents report that even well-priced properties struggle to stand out amid the noise, as buyers take their time and negotiate hard. The sheer volume of available homes gives buyers unprecedented leverage, and the typical listing lingers far longer than in any recent cycle. The supply shock extends beyond the numbers. Developers facing slow absorption and rising costs must decide whether to delay future phases, convert unsold units to rentals, or offer further incentives to clear inventory. Homeowners associations, meanwhile, must balance budgets strained by vacant units and delinquent dues. In every corner of the market, the glut of listings is a daily reality, one that shapes every decision and signals that the path to recovery will be neither quick nor easy. Ownership in West Palm Beach has become a financial obstacle course, with every step more expensive than the last. Insurance premiums, once a footnote in the cost of living, now dominate the conversation. For a waterfront home in El Cid, average annual premiums have soared to as much as $11,500, nearly triple the rates of just 5 years ago. Even inland, in neighborhoods like Westgate, owners face total annual insurance bills between $5,300 and $6,600. Flood insurance, driven higher by FEMA's new flood maps, is now mandatory for hundreds of homes previously considered low risk. Hurricane deductibles, once buried in policy fine print, now run as high as 5% of dwelling value, meaning a $1.5 million home carries a $75,000 out-of-pocket cost before coverage even begins. These costs are not theoretical. In 2025, over 60% of waterfront transactions failed or were delayed because buyers couldn't secure affordable coverage. Appraisers, factoring in soaring premiums, have cut valuations by up to 15% on canal front homes. Lenders demand proof of 2 years' insurance reserves at closing, a requirement that disqualifies many would-be buyers, even those with strong credit. In one case, a listing on South Flagler Drive was withdrawn after 3 insurance quotes came in over $13,000 per year, slashing the property's appraised value by $210,000 overnight. The mortgage landscape is just as unforgiving. With rates stuck between 6.5% and 7%, the monthly payment on a median-priced home is hundreds of dollars higher than it was during the pandemic boom. Creative financing, rate buydowns, closing credits, has become standard, but even these measures can't offset the combined weight of higher rates and insurance. For many buyers, the math simply doesn't work. Cash offers, once common in the luxury segment, are growing scarce as investors and out-of-state buyers recalculate the true cost of ownership. The pandemic migration surge that once fueled West Palm's boom has faded. While headlines still tout Florida as a magnet for newcomers, the pace of arrivals has slowed sharply. Return-to-office mandates and shrinking remote work options have cooled demand from the wealthy professionals who once flocked to the area. There's no evidence of a mass exodus, but the pipeline of eager, well-heeled buyers has dried up. High costs, not just sticker prices but the full burden of ownership, have become the market's main gatekeeper, sidelining even affluent buyers and leaving sellers with few options but to cut prices or withdraw altogether. The era of easy money and endless demand is over. In its place is a market where every dollar counts and every added expense pushes another buyer out of reach. In 2005, Palm Beach County found itself in the throes of a housing boom that seemed unstoppable. Sale records from that year show home values climbing at a breakneck pace, up 23.6% in just 12 months. Speculative buying and easy credit fueled a frenzy, with new condos and single-family homes springing up across the region. By the end of the decade, the mood had changed entirely. The crash that followed wiped out nearly a fifth of local home values by 2009. A 19.9% drop that left entire neighborhoods underwater. Delinquency rates soared above 20%, and distressed sales, including foreclosures and short sales, made up almost 40% of all transactions at the market's lowest point. The scars of that collapse lingered for years. Recovery was slow, with annual price growth hovering between 4 and 10% through the 2010s. It took more than a decade for some zip codes to even approach their pre-crash peaks. During that long climb back, lending standards tightened and speculative building cooled, giving the market a sense of stability that many hoped would last. Then came the pandemic surge. In 2022, West Palm Beach saw prices jump 29.4% year over year, outpacing even the wildest years of the previous bubble. This time, the fuel was different. Record low interest rates, a wave of remote workers, and migration from high-cost cities. Permits for luxury condos and waterfront homes soared, echoing the overbuilding patterns of the mid-2000s. The median price for a home hit $480,000 in early 2024, setting a new high-water mark for the region. But the cycle repeated itself, only faster. By April 2025, median values had collapsed to $420,000, a $60,000 loss in less than a year. The speed of the downturn rivals the worst months of the Great Recession, but the underlying causes have shifted. Instead of subprime lending and mass foreclosures, today's correction is driven by overvaluation, excess supply, and the crushing weight of ownership costs. Inventory has reached levels not seen since the last crash, and the market once again faces a long road to recovery. Archival sales data and expert analyses draw a clear line from the boom and bust cycle of the 2000s to the present crisis. The numbers may differ, but the pattern is familiar: rapid price appreciation, speculative building, and a sudden reversal that leaves homeowners and investors exposed. For West Palm Beach, the lesson of history is written in the records. When growth outpaces fundamentals, the correction is never far behind. Economists and policy experts are issuing direct warnings for anyone with a stake in West Palm Beach real estate. Dr. Selma Hepp, chief economist at CoreLogic, describes the current conditions as a prolonged correction, one with a greater than 70% probability of further price declines through at least mid-2026. Her analysis points to a market weighed down by an oversupply of listings, persistent overvaluation, and a buyer pool thinned by high mortgage rates and rising insurance costs. The consensus among major analytics firms is clear: stabilization will not come quickly, and any hopes of a rapid rebound are unfounded. Forecasts from House Canary and Redfin reinforce this outlook. Both project additional declines of 3 to 5% in median home values over the next year, with the possibility of a slow, uneven recovery only if demand returns and economic conditions improve. Local analysts cited in the Palm Beach Post warn that even as prices fall, homes remain as much as 30% overvalued in some zip codes. The implication is that further downward adjustment is needed before the market can find a sustainable floor. For sellers, the guidance is blunt. Relying on last year's peak prices is no longer realistic. Experts recommend pricing aggressively from the outset, factoring in the full cost of ownership, including insurance premiums and taxes, rather than holding out for offers that may never come. Incentives and concessions are now standard practice, and those unwilling to adapt risk seeing their properties linger unsold for months or withdrawn from the market entirely. Buyers, especially those using financing, are urged to exercise patience. With inventory at decade highs and transaction volume at historic lows, negotiating power has shifted decisively. Analysts suggest waiting for further price alignment with local incomes and caution against rushing into purchases on the assumption that the market has bottomed. Investors are advised to focus on rental yields and long-term fundamentals, rather than betting on a quick return to appreciation. On the policy front, local and state leaders face mounting pressure to address the insurance crisis. Economists highlight the need for reforms that can stabilize premiums and restore confidence in the market, particularly for waterfront and high-end properties. There is also a call for stricter oversight of new luxury development, ensuring that future supply matches genuine demand rather than speculative hope. Without these interventions, the path to recovery will remain slow and uncertain, with the risk of deeper losses growing as each month passes. The message from experts is unequivocal. West Palm Beach is in the midst of a drawn-out correction, one that will test the resolve of homeowners, buyers, and policymakers alike. Navigating this environment requires realism, caution, and a willingness to adapt to new market realities. In April 2025, West Palm Beach home values had fallen $60,000 from their 2024 peak, and CoreLogic placed this market in the highest risk category for further price declines. This investigation has revealed steep losses in both single-family and condo sectors, surging inventory, and a collapse in sales activity, facts documented in MLS reports and neighborhood-level data. Despite this, nearly a third of listings in some zip codes remain significantly overvalued, and over 5% of sales now close below asking price, far above the national average. While parallels to the 2008 crash are clear, there is no subprime mortgage crisis driving this downturn. Instead, insurance costs, migration reversals, and rising rates have combined to stall demand. Experts agree that recovery